Hi, everyone. I'm Rick Bensignor. Today is Tuesday, August 25th, and welcome to this week's In the Know Trader Show. This week, in our trader education portion, we're going to talk about the difference between having a mental stop in the market versus a hard stop, an actual stop. We'll do our weekly markets overview. And this week, I figured let's take a look at the 11 macro sectors to the market because the S&P is on all-time highs. Let's take a look at which ones are also on all-time highs, which ones are lagging, and if we can discern anything by getting a sense of each one of these 11 sectors as far as some key levels and potential breakout points or breakdown points, as the case may be. So we'll take a look at that in our sector piece of the show. In order to contact me, as usual, it's Rick at inthenowtrader.com, and I suggest you go to our website to find out more information about our weekly Tactical Trader Report, which comes out Wednesday evenings. And then, of course, we started a brand new monthly piece called 7-Eleven on August 1st. The next issue will come out on September 1st. And this is our newest venture. And what we do here in the 7-Eleven report is aim to beat the S&P's return by looking at those 11 macro sectors like we will today, but instead of looking at them in absolute terms, as we will today, we will look at them in relative terms to the spiders. And with the goal of that 7-Eleven report is to outperform the S&P by being in no more than 7 of the 11 sectors at any one time. We could be in as little as 4 or 5, but we will max out at 7 with the intent of avoiding the underperformers. And of course, if you can stay away from the underperforming sectors and be invested in those that do at least as well as the S&P, if not outperform, you will beat the return of the S&P. So that is what our intent is with that. All right, let's go back to, let me see, next slide, yeah. So let's go back to the idea here of what we're going to start with, which is mental stops versus hard stops. So let me first identify the difference between the two just in definitional terms, and then let's take a look kind of how to apply this to the market. So when you put a position on, it is important to know where your stop out is. In other words, if you go long stock XYZ, at what level underneath where you got long would you stop yourself out in order to not turn this into a disastrous loss if it didn't work? In other words, your stop out level is a level in which you decide that if it gets there, your idea was wrong. And therefore, if you bought, let's say, a breakout that didn't break out, where would you conclusively prove to yourself that that is the wrong idea, and you take your loss and you move on to the next trade. So you've always got to have a stop out level when you put a trade on. Now, some people, you can look on the internet. There's a million people out there trying to teach courses. I won't even get into that in this show, other than I've said it to you before. I'll mention it to you again. Anybody who's presenting a master class, people love to use that term these days, a master class, chances are you will learn virtually nothing. And these people are almost always not even qualified to give information. It is pure marketing scheme. It is also like using the words a powerful course taught by this supposed expert. Sign up for a master class. I just stay away from those altogether. They're almost always from people who have virtually nothing going on for them or the experience to do what they say they're going to, and they are just trying to sell you on some program that virtually guarantees, I guarantee, does not work. Anyway, let's get back to stops. It's really important to have stops. Some people will tell you don't use stops because you're going to get knocked down and then the thing may go anyway the way you thought. I don't agree with that at all. I've been doing this a heck of a long time. I'm in 40th year on the street, combined with trading, being a strategist, a pit trader on the floor of 3 different commodities exchanges. I think you have to have stops. Now, we all kind of know the concept of a stop, but there's 2 types of stops that you can think about, and one is a mental stop, and the other is a hard stop. So let's first talk about a mental stop. A mental stop would be a place that if let's say you're long stock XYZ, if it declines, so here, let's put some numbers to it. You're long a stock at 30. You may say if it gets to 27.5, that's your mental stop. And then you're going to start reviewing the charts and the analysis and decide what to do if it gets down there, because if it had fallen those $2.50, probably your analysis was wrong as far as your timing to first get in, especially now we're talking about a trade. And let's say you put in a mental stop. And a mental stop basically is a level at which you want to alert yourself to the fact that, hey, things aren't going the way I planned. And let's kind of reanalyze and make sure that there's still a reason to be long that trade. That's a mental stop. And we'll talk about pros and cons in a second to the mental stop. A hard stop is literally a level that, let's say it's the same 27.5. If it gets to 27.5, you've already predetermined that that's as much as you want to lose on your trade. And you literally put a stop order into your firm that you trade through, your brokerage firm. And generally, you can put this in on a daily basis and each day update it, or you can put it in as a good till cancel. And that way you don't have to do it each day. If you use a good till cancel, realize that, let's say, an earnings report or something could make your stock gap well beneath your stop out level. And if you don't put a limit to the sell stop, then you're just going to get filled at the market. So let's say a stock, you buy stock at 30, it's trading 28.25, it comes out with earnings, and the stock is going to open 10% lower. Well, if you had your stop in at 27.5, but the stock was trading 10% lower, you're going to get filled way beneath your 27.5 level, because you have an open order stop without a limit to that stop, and you're just going to get filled at the market when that stop opens. So I often use hard stops with limits, and I'll give the limits some room in case something kind of crazy goes on, because again, the point of the stop is to limit a loss. So let's say I bought that stock at 30 and I have a 27.5 sell stop in. I may put a limit to that stop order being filled at, let's just pick a number, at 27.25, which means as soon as this gets offered at 27.5, this becomes a market order, or in fact, as soon as it trades 27.5, it becomes a market order. And I'm saying I'm willing to let this get filled all the way down to 27.25, but no lower than 27.25. And if the stock opens lower than 27.25, then I essentially now have a limit order at 27.25. So if the stock rallies back up, that's where I'd be filled on a rally if it gets back up and through 27.25. So I often will put in a hard stop with a limit that gives it a little bit of room in case something weird goes on. But I don't want to just let the possibility happen that also I'm getting filled 10% lower than I thought I would be, because the day before, let's say the day before it closed at 27.75, and now they come out with earnings or some bad news comes and they open 10% lower, all of a sudden I'm getting filled less than at $25. And that may be something I don't want to have that big a loss. And I might take my chances that the stock will come back. So that's a hard stop with a limit. Now, let's go back to mental stops, pros and cons to mental stops. Mental stops are good, but only if you have a game plan, because you'll almost always lose more money than where your stop out level was if you have a mental stop and no game plan. So what do I mean by a game plan? Well, here, let's go to a chart. Let's go to here, and let's go to take a look at crude oil. So here's crude oil, and I kind of drawn this box around the last almost 2 months of price action, and crude's been in a range, and it's been on either side of $40 and really hasn't gone too high. In fact, today, earlier in the day, we actually got as high as, you'll notice, 43.57, which took out this prior high of 43.52. So if you had a buy stop, let's say you were short and you had a buy stop above the highest high that we've seen at 43.52, you would have been filled already, basically at the highest of the day. And you'd be out, and that's fine if you said to yourself, if crude oil makes a new high, I don't want to be short. I can't justify being short anymore. I'm out. In this case, you basically paid the high of the day and the high of the move so far. Now we're currently trading 43.20, but this traded after trading that high earlier in the day. In fact, here, let's cut this down to a 30-minute chart. You'll see that we made that high and then sold off about 80 cents or so before it's now coming back. So you would have paid the high, and as soon as you paid the high, this thing fell 80 cents. So one of the things I do, instead of necessarily having, if I had a mental stop at above the high of the move, which again, I'll go back to, and we look at it in these terms, a mental stop to me would say, let's see what's going on, and is there follow through? And in this case, there was no follow through. We took out this high by a nickel, and then we immediately fell. And we fell, a decent amount, in which case you certainly could have filled yourself at a much better price than paying the high of the day. So that's one thing to think about. But what's the game plan? Well, what I often do is I'll say to myself, I know I might lose some more money, but prove to me that taking out this high is the right thing to do to stop myself out. So it can't just be that it necessarily trades there. Let's say I put this on a 60-minute chart, and I'll say, let it trade above the prior high, which was 43.52. Let it trade there a full hour. And if it can stay above there for an hour, then, okay, now I've at least been proven wrong that I shouldn't be short. In this case, it only traded there a very short amount of time and then has sold off. And you can see even the close of that hourly bar was 43.22. So it didn't even close an hourly bar above 43.52, that prior high, let alone trade it for a full hour. So often, if I use a mental stop or even a hard stop, the hard stop might have a caveat to it. And it's often, to me, proved to me, that caveat is both a combination of price and time. So I want to see that it actually deserves to be stopped out. And yes, it could cost me more money. But in this case, let's say I'd still be short and I'd have an option to cover at a better price, or just say, you know what? This is just now a potential double top going all the way back, over a month ago. And this still may not take me out. So that's why I wanted to just bring up today the point of, I always use stops, and I will generally use hard stops with a caveat to them, or a mental stop. But again, if I have a mental stop, I have a game plan associated to it. It has to prove itself that it really should be stopped out. And again, there's pros and cons, because you might lose some more money, but you also may not get stopped out by using that, and it gives you some more flexibility. Okay, let's go back to our PowerPoint and let's move on to our sector overview. So we're going to quickly take a look at just the comparison. Notice this week there's only two sectors, communication services and technology, that did better than the S&P by more than 1% since last week. Tech is now outperforming by 23% this year. It was only at 20% last year, so a big outperformance of over 300 basis points in the last year, in the last week. and communication services picked up about 1.5 or a little less than 1.5%. Notice how many sectors underperformed in the last week. And now energy, again, is getting towards the worst levels of the year. It's down almost 44% versus the S&P. Financials are in second place, down 25%, 25.5%. Though we are starting to see now a little strength in them even today as rates have moved higher. And the 10-year is up at about 71 basis points. That's 6 basis points higher than last week. Let's take a look at charts. So now we'll just do a quick overview before we get to the 11 sectors. So here's the S&P on a weekly chart. I've drawn a couple trend lines. Notice, obviously we've poked through what had been the all-time highs from February. The count is on a setup 8 count. Next week will be a 9 as long as we close above 33.51. That is a potential pause point. I've drawn 2 trend lines. Again, a couple weeks ago, we did a lesson on trend lines. And yes, even though it cut through this magenta colored line, this bright pink line, cut through 1 bar's price action, it's still a valid line to draw based upon taking a low that's surrounded on either side of it by higher lows and connecting it to another low that on either side of it has higher lows. So I did the same with the purple line. It is the only lines, these are the only 2 lines you can draw on. Well, actually, no, there is another one. You could take one from all the way from the low here. So let's just do that as a, certainly this is still a valid trend line. Except, and we're kind of really playing with it now. But go tune into, I think it was 2 or 3 weeks ago when we did how to draw trend lines, and you'll find that valuable. And in this time frame, these are the 3 trend lines you can draw, and no other uptrend lines of real significance. On a decline, the propulsion, the bearish propulsion level has moved up to 31.39, so that is potentially initial support on a market correction. And our upside target is, let me think, 34.55 or so, I believe is what we have from the monthly propulsion target on the S&P. Yeah, I'm sorry, it's 35.55. There it is. So that is the only, well, we've got 2 numbers, 34.77 and 35.55 are the 2 numbers that are still kind of active in these charts. Of significance, again, and that's here's the TNX. So this is the yield on the 10 years. Notice the aggressive 13. This was a combo signal on the bottom here. This one came in 1 bar before the low, and these are so 1 day before the low. We are breaking about above some trend lines. It's not a clear breakout yet. It is from trend lines, but there are other models we use. And in the No Trader clients, we will talk about this in Wednesday's piece and give you a very good clue on where our definitive upside breakout level is for the 10-year. Quickly take a look at gold. Here's a weekly chart of gold. So all-time high was made a few weeks ago. We've pulled back. You can see this is one level here. This is what was the all-time highs previously at 1923. So we're kind of hanging out right around there. Otherwise, 1810-ish to 1805 or so is the next major support level. And that's all we're going to do for the macro view. And now let's take a look at the macro sector views. So we'll go through the 11 sectors now. We look like we have plenty of time to get to them. So here we're going to do these alphabetically. So I start with XLB, that's materials. You can see materials made their all-time high in early 2018. We're getting closer to those highs now. There is a propulsion exhaustion signal at 64.5-ish, which is just above what is currently the all-time high of 64.17. And support now, first level support is around 59, just north of 59 or so, where the clouds conversion line is. And considering it's going to be hard here to see unless I blow this up, but you'll see we are an aggressive 11 count. So in a couple weeks, you're going to have 9s and 13s come together with continued strength. So these have not broken out yet, and they may kind of be closer to a double top. You'd have to properly, I can't even give you the level yet at which you would need to break out above in order to then next target all the way up here in the mid 75 level. But this is something that still hasn't proven itself. So it's a laggard in the sense that the S&P is on all-time highs, but materials are not. XLC is not going to have nearly as much price history because it's much newer. Here, if I give you the, here's the weekly perspective going back to 2018 when they rejiggered these. Let me take this off because it's not even going to do much help on a pullback right now. 57-ish is the first kind of main level of support. This is on all-time highs. It's on a 10 count here. Last time we had a 13 was good for a full quarter. It stopped, and you saw the pullback before more of a rally ensued. So in another few weeks, this could start getting somewhat toppy. What do we got? A, B, C, D, E, energy. The dog of all dogs when it comes to sectors. This has been, terrible underperformer. We caught a lot of this up move in relative terms earlier this year when I upgraded the sector, but it has given it all back in relative terms. In absolute terms, you now have support potentially, I would say kind of just beneath 33 down to about 30-ish is support. And on the upside, if you can, well, there isn't really much here, honestly. This is just going to be a heavy chart. I don't see much. It could get to 40-ish or 41. You've got to get really above 41 to get any chance of retesting those highs from earlier this year. Financials should be interesting looking because they've at least been building upward since we've made the low. So the trend line has broken. So that the tightest trend line is broken. So now I can certainly look at this, and we had a close underneath it last week. We gapped higher on Monday, kind of invalidating a breakdown, and we're trading right on the line. The other line I can also draw is from this low to this low. Let's change the color. So we're hanging just above there. So there is some support here. Even though we traded beneath the bearish propulsion level, it was not qualified and confirmed, and that's why the state's dashed. So there's still support at around 23.35. Upside target would be 27 and a quarter, 27 and a half or so on this move, especially if interest rates move higher. XLI Industrials have not made all-time highs. That was back here in March, or I guess, February. But this is also fair, climbed nicely. It obviously filled this gap in here, then spent over a month consolidating in there. There's still the gap up in here. So there's still some theoretical resistance. I don't have anything in a weekly time frame as far as an upside target from here that's meaningful yet. But again, this is an underperformer in the sense that it is beneath all-time highs with the S&P on all-time highs. And in percentage terms, trading at 77 and change with the all-time high at 85, it's still a good 10% or so beneath all-time highs. So a laggard there. XLK should probably be one of the best looking charts, and it is, and it's continuously the winner. Interestingly, this week, aggressive sequential 13, and you're on an 11 count towards another 13. So this probably indicates to me that the sector may be getting tired in absolute terms, not necessarily relative terms yet, but this makes it hard for me to first commit any real money of significance into the sector now. And you can see some other 13s here, a quick drop off here, drop off here, a couple weeks ago sideways and a drop off. This didn't do anything in here, and we're getting close again. So I'd probably not be chasing after the names now. It's also the highest MACD levels that you've seen. So obviously there's just been a huge move up here, but to put new capital in now is probably not something that I really want to do. Or if I do it, I'm going to do it in limited terms and not make a big bet on something now. XLP would be next, consumer staples. Interestingly, right up against all-time highs. We're on an 8 count here too. So this would suggest, just based on how this has moved, that it has a bigger upside target, just about at $69. And at 64, you've got about a $4.50 move to the top. But the risk now is down to just beneath 61. So it's kind of an equal risk reward. If it got down to 61, probably I'd be a buyer. In here, I'm not sure I'd do anything. XLRE real estate would be next on the list. Also a bad underperformer. So all-time highs where I assume this is all-time highs. Let's just take a quick look. But yeah. So in fact, here's the total trading history when they spun real estate out from financials back in 2016. So here's what it looks like. The big March decline, it's got a decent amount back. This topped right at the propulsion full exhaustion levels, come back. Best part about this is that it did not get a sell signal and kick in a new bearish propulsion level. Let's see, down close, up close. Now it's not going to happen this week. If you can get a couple of closes above 37.18, it at least builds the case to get up to 41. But kind of a tough thing in here now to go after. What do we have? RESTU, utilities. Also, a lot of these financial ones look similar that are interest rate sensitive, and that's going to be financials, real estate, and utilities. All-time highs here, up on a 13. This is just in a consolidation factor or form right now. At least, again, didn't get the bearish propulsion sell signal to kick in. That's at least moderately good. It did get above the most recent propulsion exhaustion level, so at least over time projects up to 64 from 59. That's, that's about 8% upside versus downside of a little less than that. You're kind of in the middle of the range here, nothing special. XLV, healthcare, virtually on all-time highs, made them last week on an 8 count here too. So it's all good. Upside target is 109-ish. That's only a couple bucks from where it is now. Downside risk goes all the way to about 100. If you pull back to 100, that should be a buying zone there. And what do we have? XLY is consumer discretionary, and this is up on all-time highs. We're on an 11 count towards a 13. The 13s have been pretty good here. This 13 was very good. This 13 was good. So the aggressive 13s have been good. In red, the aggressive ones are in this dark purple. The red ones are standard sequential 13s. So both of these were good for at least the cessation of the uptrend at the time. So in another few weeks, this too would suggest that it could be running out of steam and we'd see some pullback. And if you're interested where the pullback is, anything near 136 is probably where I'd buy them. That is it for this week. Hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.